Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 12, the group B problems. And you'll have to forgive me in that for whatever reason the video just stopped. So I was working on the earnings per share at the end of the video, and just bam, it just finalized itself. Like software, you end up with these technical difficulties. So I apologize for not finishing out, and you might be a little bit lost, but we're just, I didn't lose any of the PowerPoint information, so I'm just picking up exactly right where I left off in the last problem. So we'll see how this goes as far as finishing out this video. I mean, I was 17 minutes already into the last video, and I wasn't going to re-record the 17 minutes worth of information. So like I said, I'm just picking up right where I left off, and that was where we were doing earnings per share, and our net income is 43, all right, and our average number of shares, we have to look at this and say, okay, in the previous year, notice, and this is a little complicated here, okay, so I'm going to, slow down a bit, and I'm going to explain what's actually happening here. Whereas doing all of the other ratios, it's just a matter of how I'm able to look and pull the numbers, and you saw me do that. And if you've done all that the other problems, you're able to do those ratios relatively easy. But this here is just a slight bit different and a slight bit more complicated. So I'm going to pause here and actually explain this. So we know that our earnings per share is equal to our net income, which we know is the 43, right? That's right there. And that's over the average number of common stock shares that are outstanding, right? So remember, this here is ending, is the beginning of the current year, and this is the end of the current year. And when we look at let's look at the beginning of the year. When we look at the information for the common stock, we see that we have $1 par 6,000 shares, but there's no value here. Okay, this is zero, right? That means there's no shares, right, that are outstanding. And we have $2.50 par at $3 a share, and that value is 7,500. So that means there's 3,000 shares at the beginning of the year. Okay. Now we look up here at the end of the year, and we have the same exact situation. Okay. Nothing changed, right? There's zero of the $1 par, and there's 3,000 shares of the $2.50 par. So 3 plus 3 divided by 2, 6 divided by 2 is 3, right? So we end up with 43 over 3, and then that gives us an earnings per share of 14.33, and that's a dollar amount, okay? And so that's 14.33, and that's a dollar amount of earnings per share, okay? Let me go back over that again, but I'll do it with Dream Home. Okay, so for Dream Home, our net income is 49, right? But when we look at our common shares, we have $1 par at 6,000 shares, so we have $6,000. So there's 6,000 shares there, but we have zero for the $2.50 par, right? That's at the beginning of the year. When we come up to the end of the year, we still have the $6,000 of the dollar par, right? So that's 6,000 shares. And we have zero for the $2.50 par. So it's 6 over 6 divided by 2. Obviously, 12 divided by 2 is 6. So we have 49 over 6, which gives us an earnings per share of 8.17. All right. So let me just erase this because it looks a little sloppy here. Okay, and I'm going to just, as part of my other explanation, the little bit added extra. Okay, let's just look at here to stay here, okay? It has 0 here, right? So we don't have any even though there's, $1 par in 6,000 shares, that's not what is outstanding. Okay, we have the $2.50 par, 3,000 shares. There's a value here. Now, if for some reason, let's say the uh, the value here was 6,000. Okay, well that means we would have, because it's the dollar par at 6,000 gives us a dollar par at 6,000 shares gives us a value of $6,000, right? Well then the reality is here that would be 6 plus 3 would be 9,000 shares would be outstanding. Okay, all right. So I just want you to be aware of that it all depends upon the dollar amount here. These dollar amounts that determine how many shares that are outstanding. Okay, so with that said, I'm going to pause the video and then I will work on the last one, which is the PE ratio. So pause the video, I'm erasing. Okay, I'm going to put the earnings per share here of 14.33 and their earnings per share of 8.17 here, because we need that for the PE ratio. Okay, so for our PE ratio, we had $45 is the market price, and that's divided by the 14.33, which gives us 3.14. That's 3.14. And then for dream homes, we have 35 over the 8.17, which ends up being 428. Okay, now that we've got, so pause the video, I'm going to erase this. Okay, so now that we've got all of our ratios, remember, what are we trying to do here? Assuming you are purchasing an investment and decide to invest in a company in the home remodeling business, you narrow the choice to Here to Stay or Dream Home. You assemble the following data, assume all sales are on credit. All right. Your investment strategy is to purchase the stock of the company that has a low price to earnings ratio, but appears to be in good shape financially. Right now, this is the crux of the thing. Okay, why are we creating all of these here ratios? Well, if you've done the other problems, and I've warned about this, as to everything being, all positive, all the ratios being positive, or all the ratios being negative. And, if all the ratios are positive, then you say, oh yeah, that company's improving. But if all the ratios are negative, you can say, oh, that company's deteriorating. And those were relatively easy. But don't be fooled, because, you're not looking at the comparison of a company against itself. In those other problems, we were looking at 2014 data and 2013 data, all right? So for the same company. So if those ratios improved or those ratios deteriorated, you were able to kind of like say, okay, this company is on the improve or this company is deteriorating, but that's not what you're doing right here. What you're doing here is you're taking, Here to Stay, and you're comparing it against Dream Home, right? So you're taking these ratios and you're comparing them against these ratios. And it says here, your investment strategy is to purchase a stock of the company that has a low price to earnings ratio. So if you look at your PE ratio for Dream Home, that was 4.28. versus the Here to Stay, which is 3.14. All right. So the lower the PE ratio is the one that you're initially tending to look for. So on the surface, you're going to look and say, oh, I prefer to buy Here to Stay based upon the PE ratio, right? But it has to appear to be in good shape financially, right? So what you're this is what you this is where comparing the two, one against the other in the various ratios comes into play. You don't just jump down and say, oh, my P ratio is good. No, I mean, if remember, this is a composite of all of the information, all right? And if one doesn't look, you can have a lower PE ratio, but it can look, financially, there might be problems with the company that are being covered up by other areas that excel. Okay, like for example, um, maybe you might have a good accounts receivable turnover ratio, meaning you're able to get people to pay real quick. Okay, and you might have a good inventory turnover ratio, meaning you're turning over your inventory real quick. But if you borrow too much, all right, then your debt ratio could be all wrong. And even though you're collecting the accounts receivable and you're receiving cash, your debt ratio might be all out of whack, meaning you have too much debt. So now all of a sudden the company doesn't look as attractive because why? Sure, it's making sales. Sure, you're making, you're getting the money, but the company borrowed too much. But you that's the interplay between all the different ratios. And that's why you can't just look at one ratio and say, okay, that's it, end all be all, like it's a magic number. There is no magic number. All right. So let's kind of like go down and quickly look at these ratios. On the quick ratio, um, it's saying that, that's better. Here to Stay is better than Dream Home. The debt ratio is a little bit better than Dream Home, right? Although it's relatively close, it's only 1% off. The interest coverage ratio is a little bit better than Dream Home. The accounts receivable turnover is just slightly better than Dream Home. The inventory turnover is, again, just slightly better than Dream Home. The total asset turnover, is they're turning those over. The return on assets is a little bit better. The return on equity is not as good. Okay, all right. The Dream Home, um, I'm sorry, the return on, I got to get these right. Yeah, the return on assets is not as good. Okay, Dream Home is a little bit better in the return on assets. The earnings per share is better for Here to Stay, and the price to earnings ratio um, is better. So for the most part, Here to Stay is doing a little bit better financially than Dream Home, and based upon the PE ratio and looking at the numbers themselves, I would have a tendency to want to invest in Here to Stay versus the Dream Home. But the whole point being here is that it is a you can't look at just one number, and you have to this is an okay. This is an introductory. It's financial accounting. You're being, it's the first time that you're really, really diving into this kind of information. And, so you can't they don't want you to get too overcomplicated, but just realize that it is a comparison between, all of the information and looking at it all. And, yeah, it takes, I mean, why is Warren Buffett so good at what he does? Because he spends an awful lot of time doing this. I mean, this is all he does. He gets the financial statements, he does the analysis on it, and he makes his decisions. But he's gained so much experience over time doing this, okay? And I mean, literally, that's all he does is read financial statements all year long, right? And all different companies. That's his, and he makes his decision upon that. You're just starting, you're doing, up until this point in time, this is like, the first time you're actually comparing two companies together here. All right. Realize as you do more in the future, you'll get better at it. Okay. And there is no real right or wrong. What is right or wrong is whether the numbers are right or wrong. And as far as a decision, obviously, if it's a clear-cut decision, that you should purchase one company over the other, and if you decide on the other, well, then obviously you're wrong. But when the information gets very, very muddled, okay, You have to dive deeper into that information in order to be able to make the correct investment decisions. So you end up in this gray area because different people can have different opinions based upon the way they want to invest, right? But this is just one look at how to go using the financial analysis. And quite honestly, after doing all of these problems so far, this is the first problem that I think kind of encapsulates everything that this entire chapter is about. All of the short exercises that you've done before, all of the exercises you've done before, and all of the problems you've done before have been just piecemeal, all right? And nothing has been all totally put together up until this point in time. So go back and, you know, really take a good hard look at this particular problem. If you understand this problem, then, and you understand where the numbers are coming from, you understand how the ratios are put together, and you understand the different relationships, then you're taking a giant leap forward to being able to do any other problem that you're faced with. If you're not understanding something, then you need to go back and check out the theory videos, or telephone and speak with an instructor to be able to put the pieces together. Okay. Um, so with that said, I'm done with this problem, and we only have one more to go in the chapter, and we'll be done with the textbook. So I'll see you in the next video.